All right, greetings, my dear friends, and welcome to today's lecture. The tax series has actually ended officially, so we are no longer in the tax series per se. We are doing lectures now, still on tax issues, still generally on accounting, finance, and smart tips that can help business owners get their finances right, get their record keeping right, get their taxes right, and operate viably, operate on the right side of the law within the new regulatory environment. All right, so we are doing lectures now, and for a while now we have been having our lectures on WhatsApp, and most of the lectures before this time have really been um, um, I've really been producing those lectures with my fingers typing on WhatsApp, and it's quite exhausting. So today, for a change, I decided to do a video. I know that WhatsApp does not support long videos, so I will just post the much I can here and then share my YouTube link so you can get the link and go and watch the full video there. Let's see how we can go, because it's really tiring having to type tons and tons of lecture content on WhatsApp. Is really exhausting. So please bear with me. So I just had to do a video today so that when I get home I can sleep. It's really not been an easy experience combining work, personal practice with all of the things that we still do here. But God will help us. Okay, so that said, on today's episode, or rather in today's lecture, I actually wanted to treat smart record keeping tips for small businesses. As you know, in going by the new tax reforms, record keeping is no longer just a good business practice. It has become mandatory. I think it's that section 30 of the Nigeria Tax Administration Act, if I'm not mistaken, that has now made it compulsory for every taxpayer to keep proper records. The reason being that those records will now serve the purpose of providing information on the basis of which the relevant tax authority can conduct an assessment of the taxpayer's tax liability. What that simply means is that you should keep proper records of your finances, your income, your expenses, your costs, your purchases, your sales, all of those things that you do in your business. Keep proper records such that if for any reason the relevant tax authority comes and they want to carry out an assessment of your returns, they should have records that they can look at. Where they don't have records, it now becomes a punishable offense under the law, such that if you are an individual or a business name and you have no records on the basis of which they can carry out an assessment on your business or on your earnings or on your income, you pay a penalty of 10,000 naira. All right? And then if you are a corporate body, a body corporate, you pay a penalty of 50,000. But that is even the small part. Where it gets really worse, or where it gets really serious, is that they will now resort to what we call BOJ, best of judgment, presumptive assessment. Since you don't have any books of account, any records, that they can look at to assess you for tax purposes, they now resort to best of judgment, guesswork, presumptive assessment. When we now do the record keeping tips, I will share a demand notice that the relevant tax authority served on a taxpayer somewhere in the north, is it Kano or Kaduna, running into about 75 million. The person has never filed tax returns, or most likely the person has no records. So the tax authority was forced to do what we call BOJ, best of judgment, presumptive assessment on the person, with a demand notice of 75 million. Chances are that if the person had done the right thing, kept proper records, and done a self-assessment of himself by preparing his financial statements to determine his tax liability by himself, at the very most, his tax liability may not even be up to 2 or 3 million. But because he had no records, he had never filed returns, the relevant tax authority, as empowered by law, had to resort to best of judgment, all right, presumptive assessment to determine his tax liability. And there is no, at the end of the day, when they negotiate settlement and all of that, the man may not spend up to 5-10 million, or at least 3-4-5 million. But he would have paid much less if he had kept records. So there are smart tips that I will share with small business owners that can help them keep proper records without really much manual input. It's just a matter of discipline and structure, and they will get their bookkeeping and record keeping right. Of course, we are here to render those services to them. We are here for that. But we'll still share those tips so that those that have the discipline can implement them and it will serve them. All right, that said, what we really want to discuss today is withholding tax. And I want to discuss withholding tax today because a professional colleague in our WhatsApp platform asked that we discuss withholding tax, right? I actually wanted to share this smart record keeping tips, but since he asked, let us do withholding tax today and possibly the rest of this week, and then maybe sometime last week or maybe later in this week, if we exhaust withholding taxes, we can now discuss these smart record keeping tips I intentioned originally to discuss today. That said, so withholding taxes, here we go. Now the thing is this: withholding tax is an interesting tax. It's not like taxes like personal income tax and company income tax, in the sense that withholding tax does not necessarily apply as a final tax at the point of payment. Withholding tax is what we call a prepaid tax, a deferred tax, if you like, in the sense that it is tax that you pay in advance. Okay, so withholding tax is tax paid in advance in favor of a taxpayer, such that when the taxpayer now wants to pay his actual personal income tax or company income tax, he can now claim this advance tax paid on his behalf to defray that tax liability. Let me put it this way, okay? You are a businessman. You make taxable supplies, all right, to your customers. Now, those taxable supplies you make are eligible supplies for the purpose of withholding tax. By that I mean that they are not exempted from withholding taxes. In the course of this discourse, we are going to look at transactions that are exempt from withholding tax, people that are exempt from withholding taxes, and all of those kind of things. But let us just explain the logic behind withholding taxes first. So you are a businessman, you make taxable supplies, either in Nigeria or from a foreign country, but you make those supplies in Nigeria, right? Okay, so, and those supplies you make are eligible for withholding taxes. Now, what happens is that you have made a supply of, say, 10 million naira. You, the business owner, have sold goods worth 10 million naira to a customer. The customer is now supposed to pay you that 10 million naira that you have, the value of goods that you have supplied to him. But the law says, because these goods you have supplied are eligible for purposes of withholding tax, that this your customer that you have supplied these goods to should withhold a certain percentage of that 10 million naira and pay to the relevant tax authority on your behalf. So that when you now want to pay your actual income tax, whether company income tax or personal income tax, you can take advantage of this money that this your customer has withheld and paid to the government on your behalf to clear that your tax liability. So what that means in practical terms is that you have supplied an invoice of 10 million naira to a customer. The customer is now supposed to pay you that 10 million naira. But instead of paying you that 10 million naira, depending on the nature of the transaction, depending on your status as a businessman, depending also on your residential status and on a number of factors, the person will now hold a certain percentage. The percentage is not fixed. It is multi-sectorial. It depends on these factors I have just mentioned, on whether you are a resident person or you are not a resident person, whether you are a resident company or you are not a resident company, right? So it cuts across different transactions, different industries, and different residency status. That is how withholding taxes work. But let us take, for instance, that this person we are talking about operates in the construction sector, which is where we operate from, right? In the construction sector, supply of goods is subject to withholding tax of 2%. Then other related construction activities is eligible at 5%. So let us say that this person now will discuss the percentages as contained in the first schedule to the Withholding Tax Regulations 2024 later as we progress. But for now, just bear in mind that this person who has supplied this 10 million naira worth of goods is, for instance, somebody who operates in the construction industry. He sells building materials like sand, chippings, cement, rod, and the rest of them. Now he has made supply of 10 million naira to a customer who ought now to pay him 10 million naira. But because he operates in the construction sector, and cement, rods, and all of those kind of things are not exempted from withholding tax, he is bound by law to withhold 2% of this 10 million naira. So when he withholds this 2% of 10 million naira, he's now going to pay you the balance. 2% of 10 million naira is what? Oh, my brain, oh. 2% of 10 million, would that be 400,000 or thereabout, whatever is the figure? So it will be, let's assume it is it 200,000 or is it or let's say it's 200,000? Is it, yes, 200,000? Let's say it's 200,000 naira. Even if I'm wrong, let's assume. Now what happens is that by withholding that 2%, which is 200,000 naira, he's now going to pay you 9.8 million, or he's going to pay 9.8 million naira to this person who has made the supply of 10 million. So for supplying that 10 million naira worth of goods with withholding tax being applied at 2%, you, the vendor, the supplier, gets 9.8 million. Then this man, the person who, the customer that you supply the goods to, that has withheld that 200,000 naira, will now pay that 200,000 naira to the relevant tax authority on your behalf. That simply means that the 200,000 naira that your customer, whom you supply goods to, or that this man supplied goods to, that 200,000 naira that is withheld still belongs to this man. The money is still his money, but it has been paid to the relevant tax authority on his behalf by the person who is making the payment as required by law. So that in the course of time, this will keep on happening until, let's say, at the end of the year, a total of maybe 3 million naira has been withheld and paid to the relevant tax authority on behalf of this man. Now, at the end of the year, when this man has now done his financial statements, done his self-assessment, and determined his profit for the year, and then, of course, applied after claiming reliefs and deductions, and then arrived at his chargeable profit, and then applied the taxes, and let us say his tax liability for the year is determined to be 4 million. Already is determined to be 4 million. What now happens is that he will no longer pay 4 million naira cash. Why? Because by reason of withholding taxes that have been applied on his invoices over the year, a total of about 3 million naira tax credit is already written in his favor with the relevant tax authority. That's why I said the money is still his money, but it's just that it is now kept in advance, paid to government in advance of when he will now actually pay his tax. So at the point that he now wants to pay that 4 million naira tax, either company income tax or personal income tax, right? At that point that he wants to make this payment, he will now draw on the 3 million naira tax credit that he already has with the relevant tax authority to clear it. So since he already has 3 million naira and the tax liability at the end of the year is established to be 4 million, he will only pay 1 million naira cash. That is the balance to pay his tax liability. But assuming maybe the taxes withheld over the years or over the months or within that year for him is, let's say, 4 million, and his tax liability is established to be 3 million, that is, the taxes withheld and remitted to the relevant tax authority on his behalf is higher than his actual tax liability for the year. Let's say 4 million has been withheld and paid to government on his behalf, and 3 million is established to be his actual tax liability for the year. In this case, he will not pay 1 naira, because what he has in government with the government is higher than his actual tax liability by 1 million. And this means that after clearing his 3 million tax through this withholding mechanism, he still has 1 million naira tax credit that he can still use to defray future tax liabilities. So this basically is how withholding taxes work. We are going to end it here. At least with this explanation, I would want to believe that you now understand the logic behind withholding taxes. In the next lecture, we now begin to look at the governing law that drives withholding taxes. We are going to be looking at and the persons required to withhold taxes at source, the persons exempted. Then we are going to look at penalties and special rules that apply as far as withholding taxes are concerned. So for now, let's end it here. But just before we end it here, let me make an important clarification again. I know I have done an exclusive on this issue, but whenever we talk about tax, this matter or this topic will keep on coming. So let me clarify it here briefly again. I don't know if you remember, or if you were very attentive, you will hear me mention relevant tax authority. Relevant tax authority. What is relevant tax authority? Relevant tax authority is actually that agency of government that is vested with the power to administer a particular tax. What that simply means is that it is that relevant tax authority or that agency of government that is mandated by law, empowered by a governing law to register people for the purpose of administering that tax, to receive returns for the purpose of that tax, to receive remittances for the purpose of that tax, and all of those kind of things, right? So you hear when I mentioned relevant tax authority, these agencies of government that I've just so explained have different jurisdictions. Just say it is that agency of government that has jurisdiction over a particular tax. Now, the way it is divided, we have the Federal Inland Revenue Service, which is now the Nigeria Revenue Service, and then of course the State Internal Revenue Service. Now, when it comes to taxes like withholding taxes, both the federal and the state have jurisdiction depending on the company or depending on the business that is involved, depending on the taxable person rather that is involved. If this taxable person, like this 10 million naira man that we are talking about, if he's operating as an individual or as a business name, the relevant tax authority where this person that is deducting his monies will remit that money to is the State Board of Internal Revenue of the state in which this businessman is resident. That is, if he's operating as an individual, maybe he has not registered his business at all, he's just using his name, he opened shop and is operating, and then his taxes are being withheld or his payments are being withheld in line with withholding tax regulations, then the relevant tax authority, the tax authority empowered by law to receive his returns, to receive remittances, as far as withholding tax is concerned for this particular person, is the State Board of Internal Revenue. Whether the person is an individual, operating as an individual, or operating as a business name. However, if this person that we talked about is a limited liability company, then the relevant tax authority becomes the NRS or the FIRS, which is the old name. The new name is the Nigeria Revenue Service. So once it is limited liability company, jurisdiction shifts immediately to the Nigeria Revenue Service. Once it is a limited liability company. But once it is an individual or a business name, the relevant tax authority is the State Board of Internal Revenue. So when this person withholds this 2%, is going to remit the 2% to the State Board of Internal Revenue of the state in which this businessman is resident and doing business. That is how it works. So with this, I believe that you have grasped the full logic of withholding taxes and how they apply in real life. See you in the next lecture. Clean citizens.